the European Central Bank just did it again. Another interest rate cut. While the U.S. Federal Reserve stands still, Europe is moving. So, what does this mean for the global economy? And is America now falling behind? Let's break down why the ECB's rate cut matters, and how it could shake up everything from U.S. exports to your investment portfolio. Part 1. What just happened? On June 6, 2025, the European Central Bank, ECB, officially cut its benchmark interest rate by 25 basis points, bringing it to 3.75%. This marks the second cut this year, signaling a shift toward monetary easing as inflation across Europe continues to cool. Why are they doing this? Two big reasons. Inflation in the Eurozone has slowed to under 2.5%. Growth is sluggish, especially in Germany, France, and Italy. In short, Europe is choosing to support its economy, even if it means cutting rates while other central banks are holding firm. Part 2. Meanwhile, in the U.S. Federal Reserve, on the other hand, is stuck. Inflation in the U.S. is still hovering around 3.2%, and the Fed has repeatedly said it needs to see more progress before cutting. So while Europe is lowering rates to stimulate growth, the U.S. is staying higher for longer, with rates still pinned near 5.25%. That creates a gap. And gaps, like this, matter. Part 3. Why this interest rate gap matters. Here's where it gets real. When European rates go down and U.S. rates stay high, it boosts the value of the U.S. dollar relative to the euro. A stronger dollar makes U.S. exports more expensive for European buyers, European imports cheaper for American consumers, and it tightens financial conditions for global borrowers tied to the dollar. That's great if you're traveling to Paris. Not so great if you're a U.S. manufacturer or agricultural exporter. Part 4. Are we falling behind? Some economists now warn the U.S. may be falling behind the global curve on rate policy. If the Fed holds rates too high for too long, U.S. growth could slow unnecessarily. Debt servicing costs will keep climbing. Consumer demand may weaken, especially with high credit card and mortgage rates. Meanwhile, Europe could gain a competitive edge by stimulating demand faster, reigniting industrial output, and attracting capital to its bond markets. This isn't just a monetary story, it's a strategic one. Part 5. What the Fed is watching. Jerome Powell and the Federal Reserve are aware of this divergence, but they're still laser-focused on inflation. They worry that cutting rates too soon could let inflation rebound, reignite asset bubbles, or undermine the Fed's credibility. So the U.S. is playing defense, while Europe is playing offense. This sets up a delicate balance. Cut too soon, risk inflation. Cut too late, risk recession. Right now, the Fed is hoping to time it just right. But time may be running out. Part 6. What to watch next. Here's what matters over the next 3 to 6 months. 1. U.S. inflation data. If CPI drops below 3%, the Fed will be under pressure to cut too. Labor market softening, rising unemployment could force the Fed's hand. 3. ECB's next move, more cuts could widen the gap, making the U.S. dollar even stronger. 4. Emerging market response. Many global economies follow the ECB's lead, not the Fed's. 5. Stock market volatility. If investors see Europe easing and the U.S. tightening, it could trigger portfolio rebalancing across sectors. This isn't just about interest rates, it's about who controls the tempo of the global economy. Final thoughts. The ECB is lowering rates, the Fed is holding back, and the world is watching. The divergence between Europe and the U.S. isn't just academic. It affects currency markets, global trade, and the pace of recovery across entire continents. If the Fed doesn't act soon, the U.S. could find itself stuck in neutral while the rest of the world speeds ahead. If you found this breakdown helpful, subscribe to Finance Related 101, where we make global economics simple, sharp, and relevant. Thanks for watching. Stay informed, stay balanced, and stay interest-aware.